Hey guys, Freaky Finance here. Today we're jumping into CN Rail, so we're doing back-to-back Canada plays. This is another heavier capex play. It's a railway company. I think we talked about CN Rail before. I have been following it for a few years now. I haven't taken a position until now. You'll probably hear it in my voice as we go through the video that I'm kind of on the fence about it. I was actually kind of surprised that I had 11K position it already. It is up 4, but I mean, you'll hear when I go through the video kind of like my thoughts and how I'm kind of torn on it. I think I might still be a bit early by about 6 months, but we'll see. And we're gonna go through the numbers and all that in the latest call. They reported Thursday night, so that's the most recent information anyway. But yeah, I do want to disclose that I do own this one. Railway companies are very stable. We've talked about pipelines before. We talked about utilities before. Think of a railway kind of like a pipeline, except the regulations even better. So utilities are going to push back from a regulator, like a utility, say ATCO, we talked on the channel. Alberta will push back on them if they try to push prices too high, and they'll do that on a state-by-state basis in America as well. Pipelines are different. The regulators federal level, so because they go inter-jurisdiction between countries, they tend to be regulated differently. But again, the same idea, you're trying to push price based on what's allowed, and they have an allowable rate of return on equity, basically. Railways, kind of different beast. It'll go through these long cycles where it'll be very regulated and then it will not be regulated. And they've also done a lot of consolidation. And basically with consolidation, it allows you to increase prices and increase your profitability. And there's a scale here naturally embedded in. The bigger the system, the more scale you should have. And so there is some actual like cost savings to the world the bigger the railways get, as long as they don't get too big that they're no longer competitive. So there is a balance there. So anyway, there's a big moat here in terms of capex because like Rogers takes a lot of capital to actually build out a network. In this case, the network is a railway. They also own the land. A lot of the railway companies own the land beneath the rails. So there is that. That's not the purpose of this video, but there is that behind it as well. And they are relatively stable businesses that do well over time. If you pull up a start of CP or CN, they've both done well over the long run. So anyway, this is CN Rail. So you can see kind of east to west in Canada, and it goes right down to the Gulf, New Orleans. So it's hard to know like the strengths and weaknesses of all the different railways. CN actually has some pretty good charts. Maybe I'll jump to that real quick here. So this is CN's by itself. I just picked auto. I was looking at auto before I jumped on the call because I was trying to figure out what was going on there because auto's been a place of weakness for some time. We actually picked up that during the Mobileye talk, I think. Auto's been very interesting. And honestly, we've seen a lot of risk off in union plays, so things that have employees that have unions. And I think, this is just me speaking out loud, I think we're seeing the lagging effects of inflationary pushes. So railway companies really well push price, and they tend to always push price well, but they did very well in 2022. And now the unions want a piece. And I think you're seeing that lag. You're seeing it in airlines. You're seeing it in automobiles. They did well for a bit, and now all the people want a piece. And you're going to see the reverse side of that. And I think the latest 2 quarters anyway for CN definitely show that squeeze in labor, and we're going to talk about that. So and we are seeing cheapness across the board in automobiles and stuff like that. And I think it's all kind of connected to a union theme. Like if you have a union, you're going to be selling off right now. That's just me thinking out loud. So anyway, this is the full map of CN Rail. So basically coast to coast and then to the Gulf. Big T. Actually, eerily similar to Enbridge's when we did that. So what else is there? I do like CN's because it's interactive. So this is all the different radio stations, rail stations, all the different lines. So you have CN, you have UP, so Union Pacific. There's only 2 that I've really looked at in detail before. This is the first time I've owned a rail because they tend to be expensive, right? And so you're kind of waiting for them to get cheaper, then you can buy them. So Union Pacific was one that I looked at and owned for a bit, and I just sold that. And now I'm looking at another one, and we are seeing opportunities here. And generally they sell off with the market slowdown. So during a recession, volumes slow down, and you'll get multiple contraction slightly at the same time earnings per share decrease, right? So you finally get an opportunity to buy while things normalize. And it is a very stable, steady business over time, right? And unlike, say, what you think about telecommunications and satellites, rails are going to be here forever, right? Just a cheap way to move a lot of heavy goods over vast distances relatively quickly and cheaper. And it is critical infrastructure. So anyway, it kind of just shows the different, how they're kind of situated. So you can kind of see branches all the way across the heart of America, and different ones go different ways, north to south, east to west. You can see pink here for NS. So it's interesting anyway to look at them if you were to try to like break them out and see like where you wanted to go in America at a certain point in time. It could be interesting, but that's not today's purposes of the video. This is from the annual report last year. So this just kind of shows, I just wanted to show the breakdown of business mix. You can see relatively diversified. So Petro, so oil, metals and minerals, forest products, coal, grain, fertilizers, intermodal, and automotive. So those are the main ones there. 1, 2, 3, 4, 5, 6, 7. 7, and then really kind of like 5 bigger ones, and then coal and automotive are the side guys. And we're going to go through them all, strengths and weaknesses, but it does help show like it is a diversified footprint. It doesn't rely on one specific industry. It relies on a lot of different industries. That's just worth pointing out because you're going to see it when we go through the numbers. This is just the recent acquisitions they did in 2023, so not that recent, but last year. And you can see that the consolidation game is still strong. Railways are still consolidating. We saw that with CP in Kansas. It's going to be an ongoing theme, and it's nearing, actually. It's getting pretty consolidated. So that's just worth bringing that out. And it is a point of scale over time and synergies. I was just digging into properties before I jumped on the channel. You can kind of see that most of the properties are in track and roadway. So while you do see, like, you'll see the big 44 billion, I think it's even higher this year in PPE, a lot of that is in the tracks and railways. So, and roadways. Not too much actually in buildings like you might think. It actually has more in IT than it does in buildings. So just thought that was worth pointing out. All right, let's jump to the numbers before we jump into the presentation. So CN also has a good resource. You can just export it and you can kind of get the information you want. I added this column for 24 just to kind of get it. Obviously, I like to put a lot of zeros to make it bigger, so 17 billion. So not just 17,000, 17 billion. You can kind of see the main cost centers. So fuel and labor are pretty big ones that tend to change a lot. Purchase services material does go up slowly over time, but the ones that are going to move around a lot are labor and fuel. So the price of oil does impact fuel, right? And the price of labor tends to go up over time, though it does go in different times. You can see when fuel jumped in 22, when we had the big Russian invasion of Ukraine, you can see fuel expense jumped $1 billion year over year, but CN was able to push 2.7 billion out on the top line, right? So you've seen CN be able to ride out, I think, fuel very well in its contracts. It pushes it through very well, whereas it's not as proven here. Now you can see here it looked really good, right? You increased revenue by that much and only paid out this much more. But then you get the side effect where we're on now, where you have strikes and unions and agreements, right? And so you're getting the where's my pound of flesh after you made your money thing. And this is at the same time, like this is when we over-earned because we saw all the spending shift to goods because the COVID shut down the world, right? So people were spending a lot on goods, which required more freight. This was exacerbated, like when we look at a trucking company, which we're going to talk about really quickly because of intermodal. But you can see the over-earning, right? It's just clear as day, and now you can see kind of like the recessionary part of it after the fact. Now, CN, the rail is a lot better business than trucking is, so it's not a recession for these guys there, but they're just rate of change decel year over year, and you're seeing it in operating income going down year over year, right? This is 2 years in a row now. So what else is there to bring out? This is just my thoughts to myself. Year over year, Petro was really the only one performing out of the 7 segments that we talked about. The rest are kind of flat and maybe down slightly. Automotive was very weak. We're going to talk about that really quickly as well. And then my thinking out loud is that Q3 and Q4 of this year that they just put up, an earnings result they just posted up, were very weak. And I actually think that means that next year, like the Q3 and Q4 of 25, are going to be very good, all else equal. So it kind of gives me time because some of these things are structural, like labor is higher and revenue is still kind of flattish. Now they are guiding, and I think that's one of the reasons why the price isn't coming down as much as it possibly should be. is because they're guiding the 10 to 15% EPS growth year over year. So basically, they're saying we're going to recover a lot of the earnings we lost because of the strikes, and they're probably going to push through some of this with labor inflation, I think. What else is there? Depreciation is a big part of the expense structure. We're going to talk about the CapEx, which is a big part of it's a CapEx heavy model. So unlike when we do things on like Airbnb and Pinterest, which have like very low CapEx, this is higher CapEx. So that's worth pointing out as well. These things are free cash flow machines, though. They do generate a lot of free cash. They just put a lot of it back into the business. And then they pay out a decent dividend, and then what's left over is usually buybacks. Here you can see interest expense slowly go up. So you have operating income going down year over year for 2 years in a row now. And then you're having interest expense tick up. And what's happening here, even though they're free cash flow positive, is that they're taking on debt to buy back shares. And they're buying back shares relatively aggressively, probably at a time where they shouldn't have in 2022 and 23. But that's hard to say because these railway companies generally don't get that cheap for too long. The market, for whatever reason, doesn't give good deals, I think. And probably because it's so defensive and so reliable earnings that it doesn't get as cheap as I would like to buy it at, right? But that's just my conjecture. But anyway, you are seeing that here. So you are seeing here, it shows up like a sore thumb, right? And the indebtedness is ticking up, going from 12 billion to 15 billion to 18 billion to 20 billion, right? So it is ticking up, and that's putting pressure on interest expense. But overall, like you're still only at 2.5 times debt to EBITDA. So you're still relatively low in terms of debt. So the reason why I think some of the EPS is held up better than it should have is because they decided to buy back shares on debt on the last 2 years, which has helped keep the share price high, I think. Higher than it probably should have. I haven't been seeing as much weakness as I would have hoped to get more excited on the name. And I say that as someone who already owns it, right? I would want a cheaper price to get excited, right? Like Rogers is at multi-decade lows, or at least a decade low, right? On earnings that are just increasing year over year. This one's decreasing year over year, and I'm still paying 20 times earnings, right? So it kind of shows you what's being priced in and what's not. People are obviously looking through the current year and the current strikes that they just went through, and they're saying next year is going to be better, and they believe it, right? That's what the market's saying. They believe it right now, anyway, or at least that's my opinion. So anyway, you are seeing a sale. So you're seeing fully diluted share count go down. You're seeing equity EV go down about $16 billion year over year, which is nice. But you are seeing the debt slowly tick up. Overall, the EV to EBITDA is actually getting cheaper. So you're almost a full turn cheaper, which is nice. So you are getting a deal in terms of that. It's just not in terms of GAAP earnings. You're not really seeing it yet. Though if you're looking through it, you're expecting 10% EPS growth year over year, 10 to 15, you're probably at 18.5 or 19 times earnings. So it's getting cheaper for a rail company, but it's not dumb cheap. That's what I'm trying to articulate. In terms of the free cash flow, like I said, they do generate a lot of free cash flow, relatively steady free cash flow. CapEx has crept up a bit, and the free cash flow is under pressure. They do pay out a decent amount of dividends, even with the free cash flow under pressure, with strikes and bad winter relative to last year, fuel prices that are still relatively high. I mean, oil's still at $70, which is really good for a lot of companies that we own in energy still. Anyway, you're still seeing relatively decent free cash flow, which is covering the dividend. So even though the dividend's been increasing every year, they increase it again at the earnings call that they just did. They can still easily cover it. So that's important if you're a dividend holder, owning it for a dividend, even though the yield's not that high on this thing. And then you have the buybacks. And the buybacks, you can see, are more than what the free cash flow after the dividends paid out would have been. And that's the debt. Basically, they're taking on debt to make the buybacks happen. So a lot of this fully diluted share count, which is amazing, right? Going from 722 to 629 in 6 years here. That's really good. But it came at the expense of debt. Now, it's not all debt. They did, like, whatever the remainder of paying out the dividend would have been after free cash flow is also going to buyback. So that is good for us, but it's not ideal. I never liked seeing debt, but to be fair, their debt was low, right? They're still only at 2.5. That's what they did. So it's worth bringing up. The balance sheet's still fine. It's just not as good as it used to be. Here you can see the operating margin. So under pressure, they mentioned on the call, they talked about, basically they kept talking about the strikes. and a harder Q4 in terms of winter weather, which is fair. Alberta and western provinces have just seen a little bit more snow year over year in Q4, and some colder weather. And that just happened in terms of rate of change. And I think it exacerbated the conditions with the port strikes that were already ongoing. And you can see that in the PM too. So whatever happens on the operating line, like basically whatever happens between revenue and its operating expenses dictates what happens to the bottom line. So basically you're seeing operating margin come in at the same time PM's coming in. So profit margin, the bottom line. So kind of basic stuff here. We're not going to go into too much detail on all the business lines because I'd be here for a while. But I do like, and they export this, so you can see it year over year. You can see like what they make per mile for freight revenue. So you can see them take price very well in 22, going from basically $6 where it was sitting around to $7. And now we've been stuck at $7 for 2 years again. So they take price and then they stop. And so it's like, what's going on? So they should take price again, especially given the labor and pressure that they're seeing, but they haven't yet, which is interesting. Because at the end of the day, if the union wants to get paid more, increase the labor wages, and the railway should push it through. It just depends on a leg. And honestly, the union wage pressure is after the fact, right? So it's kind of exasperating the situation because shifting has shifted back to services. So you're seeing less demand for freight at the same time. People want to get paid more, right? So just a little bit of a squeeze happening. So I am kind of surprised that the multiple is held up as well as it has. I mean, in terms of operating, like what it can control, the railway's doing pretty good. Like even with the winter, they're at 209 in terms of car velocity, which is their like speed of the rail. So things are moving well. So it's not like they're operating poorly. It's just they're under pressure from structural things like labor. And in terms of injury frequency, it's also down, which is nice, right? It's also worth pointing out that it is operating well. So that is maybe a reason why the multiple hasn't come in as much, because they do think that what they can control, they're doing well on. So I mean, part of that should be controlling union pressure. This is them just talking about the port outages. Like the whole call was about it, how much pressure it put on, how much they had to overstaff for certain parts of the quarters for the last 6 months. 24. They did say that 2020 is off to a good start, or 2025 is off to a good start, which is interesting. So maybe that's another reason why the multiple hasn't come in that much, and it kind of indicative that the market's looking through the short-term weakness. Here's JB Hunt. So I like to look at trucking companies and compare them to rail. I just kind of like my transport look through because a lot of books mention that transports are a good leading indicator. It's been kind of back and forth. I mean, the stock market's also a good leading indicator. So, but sometimes now and then you can see divergences where the stock market keeps going up and transports are fine, or maybe transports are fine and the stock market's going down, right? And it can kind of give you some fun insight. That's neither here or there, but I like to look at this company specifically, JB Hunt. And I just thought this was a really good comment because this is also in January, just 2 weeks ago. In closing, we sit here today at or near the end of the worst freight recession we have ever experienced. So it's a trucking company, having just reported 2 consecutive quarters of record intermodal volume. So, and this is an American company, so it's worth pointing that out. But it kind of is indicative that we're finally seeing intermodal stop being horrible. So maybe we've finally seen enough capacity come out of trucking. That's what it could be indicative of. Now, I don't follow a lot of trucking companies. I just thought this was an interesting comment to read. And a lot of people, like, if you talk to them, no one mentions 2 years of a recession in trucking, right? No one's really seen it, but it's happened and we've already been through it. So it's just interesting, is what I'm trying to say. And this kind of just shows what a recessionary environment looks like to a COVID winter. So this is when the world shut down, and you can see everyone get money and they buy goods because the world shut down. And so you can see trucking just shoot through the roof, intermodal, just and basically, I mean, it's kind of in the name, 2 different modes of transport for moving goods. So say just think rail to trucking or truck to rail, probably more common ones, but basically 2 different modes of transportation working together. So anyway, you can see it, the recessionary hangover after the fact. So trucking is very vicious because when things are good, you can easily get more trucks on the road. You can make your own trucking company and prices are still good. And then all of a sudden they're not good. Prices are falling and capacity needs to react to that. So trucking has its very own supply and demand market, whereas rail is very rigid. No one's going to show up and build a new railway. It would just be way too cost prohibitive, especially with how expensive land is, let alone the materials to make these things for miles. Anyway, what am I already at? 21 minutes? Okay, I'm going to try to go faster here to close this out. Employees have started to finally come back down, so they are reacting to the volume declines and the strikes. Here, I like this because it shows you the freight revenue per mile per business line, so you can basically see which line there took price in 24. And you can see really the only ones that they really took prices in the Petro. See, forest products, they took a little bit of price. Coal, they took a little bit of price. Grain, they took a little bit of price. You can see intermodal and automotive have just been horrible this year, right? And it was really bad in Q4, like automotive down 10. And it's not like last year's automotive was that good either. So it kind of just tells you how bad the automotive industry is right now, or at least has been. It's just worth pointing that out. And according to America, or JB Hunt, intermodal is finally recovering, but we're not seeing that in rail yet in Canada, which is interesting. To be fair, intermodal for rail hasn't corrected half as much as not even close to what trucking has corrected. Like we're talking like 20 to 30% EPS drops, right, in intermodal for trucking, whereas this thing's down 5 in price. Anyway, I always like that. This is their outlook, and I think this is the reason why the multiples held up, is because they're basically saying we're going to get what we lost back in 24 or 25. And they did say they're only going to spend $3.4 billion this year, so reduced by $100 million in terms of capex. So they're putting a little less back into the railway. So worth bringing out. They are raising dividend again. It is a big dividend play over time. All right, what else is there? In this slide, I just thought this was interesting. So you are seeing better resource management in terms of labor. I think the strikes really hurt their cost efficiency in terms of labor. They had to try to hire new people while other people were striking, and then when the strikes were settled, they had extra people that were trained, so they had to lay them off. And they talked about furloughing on the call, and we're going to jump into that really quick. This is their outlook again, kind of seeing they think what's going to be better. They think Petro, which was already good in 24, is going to continue to do good. Chemicals and plastics going to grow. Metals and minerals will be flat, and forest going to be down. They also, a part of this is tariffs. They're thinking that certain things are going to be weaker because of tariffs. So they are trying to price some of that in. They're not pricing in a recession in Canada because of the tariffs or in their guidance, but they are thinking that it's going to put pressure on certain of their business lines. So, and they are guiding to that, which is good to hear at least. Though they guided really strong last year too, and they failed miserably. So we'll see what happens here. International domestic's doing fine. Automotive they think is going to be flat, which is interesting given how weak Q1 still is, or looks like in the middle of just started February. Today is February 1st, 24 or 25. What year is it? Jesus. All right. let's go into it. I thought this was interesting. I like to see the land when it happens, just to see how they're treating it, what it's on the books. So this was marked assets held sale, sold to the government of Canada for a nominal amount. They actually recorded a loss on it, which is interesting. So this can happen. So not all land is going to be marked up, but then right below it, you have one where they're basically the whole thing is proceeds. So they marked the asset value of the land down to 0, and then they sold it for $130 million. So that you're getting two different stories here in terms of land. And I just thought this was interesting to show because it is kind of cool to see it when it happens, because there is a value here in the land underneath it, but no one would value right now based on the land. But it's worth pointing out, right? They completed a sale of land in the Bala subdivision near Markham and Richmond Hill. Cash proceeds of $129 million, which resulted in the gain of $129 million, as the carrying amount of the land was nominal, aka it was like 0. So I just thought that was funny. What else is there? The stock chart at CN over time, it just takes price and grows, and it does run efficiency. We did see the efficiency ratios and safety were very good. So they are doing things right. It's just you have pressure at different times in different expense items, right? And sometimes they really seem to be very able to push price, and other times they're not as able, or maybe they're just not willing. I don't know. But it's just interesting to see it play out over time. So we have seen the stock kind of come back. It's not as cheap as I would hope it would be, given the earnings correction that we've seen. Again, the market's, like I said, a lot of it looking through it. But in the longer term, rail's pretty good business. You can kind of see it here in Canada, right? There's only 2 of them. It's probably not that competitive. They could probably take price if they want to. They're just trying to be gentle about it, I think, or gradual about it. I don't know. This is just notes on the call from their thing. And this is them just reissuing. I kind of we talked about the strikes, the labor disputes, months of uncertainty, and division of container volumes for a longer period of time. It's 3 months. So that is something we're comping, but again, that's going to be back half of 25. So it's going to make the back half look really good. And so I just don't know how cheap, kind of like my Rogers comment, I don't know how cheap it gets. Though Rogers is dirt cheap, right? It's 10 years, multiple cheap. Whereas CN technically is holding up in there. So different beasts, different businesses. One is giving me a real value. One is kind of, I want it to give me a value, but it's not giving me what I want. This line was interesting, right? We've remained disciplined in managing headcount. Adjustments are underway. Where volumes are growing mainly in the West, we continue to hire with furloughed trainees on standby to quickly respond to demand. So they basically have people waiting to jump back in, which is an interesting place to be, right? They're trained. So they, like, again, because of that they had to train new people. Well, people are striking to come back. They have to furlough the people that they tried to train. And so as the volumes come back in, the normal attrition happens, they're able to pick them back up and have to retrain them. So that is worth pointing out. So if things are good in Canada, if things pick up, the economy grows, there's no recession, you probably will see pretty good economics in terms of labor, which hasn't been the case for the last 2 years, right? It's been pretty bad. And that's worth bringing up. What else is there? This again, so the operating ratio is like operating expenses divided by revenue actually shot up. That's not good. You want it down. So, and it was up 3% on revenues that were down 3%. So that's basically the squeeze in Q4. So Q4 was a bad quarter. The quarter they just posted. Labor was 7% higher than last year, mostly on general wage increases and payroll taxes. So you just had 7% inflation on your highest cost line. Like what? And you barely took price? Why? Right? So was it because you took too much price 2 years ago? Or are you just trying to be coy or small now because you're seeing what happens when you take too much price at once because everyone wants a cut? So I think the later, but it's worth pointing out here, and it's a very interesting thing. CapEx, kind of talked about that already. It's down 100 million year over year, so not a big change. Dividend increased again. I think I just thought it was interesting that they IPO'd in 1995. Here they're reaffirming their long-term EPS guidance of single-digit EPS CAGR for the next 3 years. So that's worth pointing out. It is a grower. It does grow earnings year over year in a normal environment, though it hasn't for the last 2 years. So that's kind of fun. So I was just hoping that the multiple would come in a bit more than it has. Here's actual people. So we have 120 plus for load and transportation, 100 in mechanical, and over 120 locomotives and storage. Basically, they're saying if things pick up, we're ready, because volumes haven't been that great for goods, especially relative to 22. Shifting has shifted to services, more balanced. Thought that was worth bringing up. I think that's everything. Oh, this is probably the last thing. What is it, 30 minutes before I edit it? Okay. Here is just the weekly volume. So CN actually posts this every week. It's kind of nice to see the year-over-year trend, so you can kind of see what's currently doing better. So we're actually doing good so far in the first 4 weeks of 25, though it has started to snow again, so we're probably going to see this go nosedive again. Winter is kind of interesting for the comp set. So basically, winters could be really hard, a lot of snow, they have slow velocity, and then they can pick things up when the weather is better, right? And if things are super cold, things slow down a lot. I mean, super cold is relative term, so usually minus 25 is when I'd say it's cold here. But anyway, you can kind of see the trend over time, and I like this because it's in real time. You don't have to wait to earnings call. You can refresh it every week, and it's here. So I like looking at it because it kind of tells me like if I'm getting a deal or not, or maybe why I'm not getting a deal, right? Maybe I'm not getting a deal because the guidance is good, and recently we're seeing year-over-year improvement in terms of RTM. But that's just my opinion. I like to know your thoughts on CN. It's an interesting place to be in. I'm probably going to trim some just because Rogers getting cheaper, so I might just do that. But actually, it's funny. I have this portfolio and it's so fluid, and then I see an idea and I'll swing some into here, and then also I was like, how do I have? I was expecting to have like 5,000 in CN Rail. I was like a 10,000 position, which I mean, it's still not a full size position. It's just more than I was expecting to have at this time, especially when I do this video. And that's why some of these videos are so good for me, because I can be like, am I that excited about it, or is there something else I can do with the money? or do I have time? Right? Do I just want to make the dividend if it goes flat for the next 6 months, right? Before it hopefully accelerates and goes into the guidance like they said it would. It's kind of my thinking out loud with this company. But yeah, I'd like to know your thoughts on rail. They're interesting business models. They'll have different links. We don't know how tariffs are going to affect it, which are going to be supposedly announced this weekend. Right? That does add to uncertainty. I'm just surprised the multiples held up so well. But anyway, I'd like to know your thoughts and have a great rest of your week.